look at debits and credits and making a trial balance. When Italian monks back in 1400 first wrote about how to do bookkeeping, they had been using for a couple hundred years at least at that point a system of T accounts. And these have a left side and a right side. And back in Latin that they wrote about how to do this, left side, the word in Latin is debere, and right side is credere. And then later on, debere got shortened to debit in English, and credere got shortened to credit in English. But they still just mean left side and right side. Another shortened version is DR for debit, even though the English word debit doesn't have an R on it. The DR goes all the way back to debere. And CR for credit is a shortened version for that. Now, the accounting equation is that we have talked about in previous videos is the assets equal the liabilities plus owner's equity. And so we have assets, A, is on the left side of the equal sign, while liabilities and equity are on the right side of the equal sign. So when the Italian monks, or those before them in fact, decided what was a debit and what was a credit, since the assets were on the left side of the equal sign, they said that anytime there's an increase on an asset, we're going to call it a left side transaction. We're going to put it on the left side of the T account. Whereas liabilities and equity, if we have an increase in those, since they're on the right side of the equal sign, we're going to put an increase in those transactions on the right side of the T account. And so an increase in an asset is a debit, and a decrease is the opposite. Okay? An increase in an asset is a debit. A decrease would be the opposite of credit. Increase in liabilities and equity would be credits, and a decrease would be the opposite. So here they show you, they talk about in equity in particular, you have to know which types of things increase equity, which types of things decrease equity. So we learned in a previous module that owner's investment increases equity. And we know that revenues, when the business sells its products or services, we have revenues, and they increase equity. So any transaction in which is an owner investment or a revenue is involved, we're going to have a credit in the equity. And if we have a decrease in equity, which when the owner withdraws money, or there's an expense where the business uses products and services of others, then we have an expense, and that decreases equity. So we have the opposite of credit, we have debit. Now, we not only do we look at increases and decreases, and we will look at those in more detail later in the semester, we also use this as balances. So assets that are on the left side of the equal sign will have a debit balance normally. So cash, accounts receivable, supplies, etc., those kinds of things that are assets will have a normal debit balance. If suddenly you have negative cash, such that you have a credit balance in your cash account, that's abnormal. Okay, so you want to make sure that in Accounting 101, we are never going to be abnormal. We will always, always, always be normal. So all of your assets should have a debit balance. Your liabilities should always, always, always have a credit balance because that's normal for liabilities. With your equity-related accounts, depends on what kind it is. So if it's the owner's capital account where owner investments go in there, or it's a revenue account, those things which increase equity, they will have a credit balance. But if they decrease equity, such as the owner's drawing and the expense accounts, they will have a debit balance. Now, rather than trying to figure this out from looking at the equation, there's another way you can do this, which is to just memorize the following chart. So here we have the chart. So a balance is a debit for AWE. Okay? Assets, withdrawals, and expenses all have a debit balance or should have a debit balance on your trial balance. Whereas the balance should be a credit for LI&R, Lear. Liabilities, owner investments, which is going to be the capital account, and revenue accounts should all have a credit balance to be normal. So if you take this and you memorize this, then that will just make it easier for you to know what kind of balance goes into the trial balance, what kind of balance each account should have. Now, there are things called contra accounts. And in a contra account, it is attached to another account, but has an opposite balance as the rest of accounts in that type. So if it's, say, a contra asset, it's attached at the hip to some asset account, but has an opposite balance. So we just learned that assets have a debit balance. A contra asset would have an opposite credit balance. Now, there aren't a whole lot of these contra accounts, but one of them is accumulated depreciation. So you have equipment is an asset, and you have accumulated depreciation dash equipment. That is a contra asset. It's attached at the hip to the equipment account, but it shows how much we have depreciated of that equipment, which we will learn more of later in the semester, what that's about. In that case, accumulated depreciation is going to be a contra account. Okay? We'll cover more of that later. Okay, so again, it's attached to an asset but has a credit balance. And one example is accumulated depreciation dash equipment, which might be written A/DEPR. Okay, so equipment itself is an asset. It has a debit balance. But accumulated depreciation is a credit balance because it's a contra asset. We could have a contra liability. That's one that's attached at the hip to a different liability account, but it has an opposite balance. A liability has a credit balance, but a contra liability would have opposite, which would be a debit balance. Here's an example, discount on notes payable. We won't really be using that until we get to accounting 102. So, or actually maybe even accounting 201. Okay? But again, notes payable is a credit balance because it's a liability. But the contra liability that's attached to it would be an opposite balance, a debit balance. Okay, now if the total debit balances of all the accounts that have a debit balance, if we added all the debit balances up and totaled them up, then we totaled all the credit balances up, they should equal the total of all the debits should equal the total of all the credits. That means, okay, if the total of all our debits equals the total of all our credits, that means the total of all our assets should equal the total of all our liabilities and equity. And the accounting equation would balance. If all our debits equal all our credits, the accounting equation balances. And it must balance 100% of the time. So that's what we want. Okay. So in bookkeeping, we analyze and record all the business transactions. We learned about that in chapter 1. But we're going to use debits and credits to analyze those transactions and record them into a journal. Then we post those debits and credits into a separate accounts in the ledgers. Okay, that's the classifying step that we learned about in chapter 1. Okay, we're not going to do any of this till later in the semester. Okay, but I'm just telling you, this is the process that we go through. So then there's a separate page, there's a separate account for every single account in the chart of accounts, has a separate account in the ledger showing its balance. Okay? And so if I add up all the debit balances in the ledger to all the credit balances in the ledger, that will show me whether my accounting equation balances. To do that, we're going to make a thing called a trial balance. And that lists out all those accounts that are in the ledger and along with their debit and credit balances. And then we total up the debits and total up the credits and make sure that they equal. And that's what the trial balance is all about. So here's just a summary of what the trial balance is. It's a listing of all the accounts and their balances. It's a totaling of all the debits and credit balances. It's a proof that the debits equal the credits. If it doesn't, then you have a mistake in your ledger and you got to go find it. Okay? And it's proof that the accounting equation is in balance. We use a trial balance to help us prepare financial statements, which is your next module. And we're going to, in the next video, we're going to take a